we're doing well. Welcome back to the LAGFX channel. Today we've got another learn to trade video. As you would have seen by the title, we're going to go over everything to do with Wyckoff, so Wyckoff 101. Now the reason I wanted to create this video in this episode of Learn to Trade in the series is because I do mention Wyckoff or entry confirmation or the third step within my three-step approach all the time, and I know a lot of people are actually confused by what really is a Wyckoff schematic. And most of the time when people learn, all they'll do is look at the images online of what a schematic is, but we have to understand that those images do give us the base foundation of what it should typically look like, but we have to understand the idea that every single Wyckoff schematic is different, so there has to be a couple of laws that it follows, and these laws are not commonly taught. So jumping straight in, I'm going to talk about accumulations and distributions. So these are the common schematics we use when looking for entry confirmation. Why is this? Well, that's because they mark the reversal of the current trend. So a distribution, that marks the stopping power of an uptrend and the start of a downtrend. On the flip side, an accumulation marks the stopping power of a downtrend and the start of an uptrend. It's for this reason that I use them as entry. If you don't know by now, I do use a three-step approach to the markets. I will flash that on the screen now. Quite simply, obviously first we do our top down, get our story, get our bias. Secondly, we're looking for those points of interest. And then third, why do we need Wyckoff schematics as entry confirmation? Well, that's because the strategy is pretty much all about finding major swing points in the market. So waiting for price to approach that point of interest, it reversing inside of the point of interest, and then making a move in the opposite direction. So everything about the strategy is understanding when and how the market is reversing in order for us to be involved in that movement as early as possible. So if we can understand what an accumulation, what a distribution is, then we're going to be so much further advanced within the strategy, because we can really refine our win rate, because we understand when is the market really reversing, where do our parameters need to be, and how likely is it for this setup to play out. So on screen here, you've just got a picture of the accumulation of a distribution. As I said, don't get too familiar with these. Just understanding an accumulation marks the stopping power of a downtrend, the manipulation, and then the creation of an uptrend. Distribution, the stopping power of an uptrend, manipulation, and creation of a downtrend. They'll both typically follow around about the same patterns you're seeing, but as I said, there's just a couple of laws we want to look for that we want it to follow. So now reaccumulations and redistributions. So these schematics are commonly referred to as stepping stones. We'll get more into that on the next slide. So they are used to aid the current trend and ensure that the final target for price is met. So the idea being, we have the composite man. Now, Mr. Wyckoff believed that we should view the market with the ideology that there's one single man controlling every single movement, with the sole purpose of lining his own pockets and taking money away from ours. So a reaccumulation, that is used to introduce more demand into the market, aiding an uptrend. A redistribution is used to introduce more supply into the market, aiding a downtrend. It is not common that we would use these schematics to trade from, but it is important to know what they are and what their purpose is within a Wyckoff price cycle. On the screen now, you will see reaccumulation, redistribution. Again, just familiarize yourself with what they are, what's really happening here. With a reaccumulation, price trades up, build liquidity, manipulate liquidity, continue moving higher. Redistribution, price moves down, build liquidity, manipulate liquidity, continue moving down. So Wyckoff price cycles. This is the understanding that every single time we reverse in the market, so creating a swing low or a swing high, we have to undergo the creation of a schematic. So you're going to see how the reaccumulation and redistribution are used to aid price within these movements, ensuring that the supply and demand balance is always in their favor with the desired move. A Wyckoff price cycle will typically always have a mean movement, whether this be up or down, so whether we are in an uptrend or a downtrend. You will see examples of this when we hop into the live markets just in a second. So on your screen, you're going to see just a quick example of the early concepts of a Wyckoff price cycle. Just have a quick look, but it will make much more sense when we dive into the markets. Now finally, before we really do dive in and start getting into the practical side, I've just put these on screen, so a displacement and an S&D flip, pause the video, have a quick read through, because this is going to be one of our major laws when we're looking at distributions, accumulations, confirming them, and looking to trade from them. Okay, so jumping into the live markets now. I've just brought up the Bitcoin to the US dollar market. How come I've done this? Now, this just gives a perfect example of what a Wyckoff price cycle is. So you'll see on the screen, I have actually marked up everything that I am seeing. So we're trading up. The first thing we find is a reaccumulation. So what did I say that was? It was like a stepping stone. So we've had a sharp move higher. We have exhausted the demand in the market. So we're struggling to really just continue this high volume push up. So what did we want to do? We want to start manipulating people out of the market by building and clearing liquidity. In doing that, we've introduced more demand. You'll see after the spring was created, we then move up again with high volume because we've introduced enough demand in order to do so. We then trade up to an overbought area of the market where we distribute, building liquidity to the upside, clearing it, introducing supply to then cause the move lower, which comes to mitigate positions within the reaccumulation, also reaching us down into an oversold area of the market. We build liquidity, clear it to the downside, move higher, again reaccumulate in order to ensure there is enough demand for this move. We then come up, distribute again in the overbought state, move lower, so on and so forth. Now, if you remember correctly, I said that there's going to be a mean movement. We should be able to tell by now this is bullish movement. So we've had high set, low set, higher high. This means we are following bullish movement. The average direction is up. So each time we reach that overbought area, each time we distribute at the top of the range moving forward, we want price to have surpassed the previous high. Each time we move lower, we want price to reach an oversold area higher up than the lowest point of the accumulation. Now let's really dive into this distribution for now, just to give an example of what really happens here. So in the first phases, so in the very start of the distribution, we're obviously going into this point with a very high demand, evident by the large push up. Now what we have after this is an automatic reaction. Now that is giving us signs that supply is entering the market because we've had this large pullback. We've had this large move lower, which means at this point, we've been able to introduce enough supply in order to do that. So that is early signs that we are having a bit of a tilt in the supply and demand balance. Demand is no longer as dominant as it once was. We'll see again that now price is struggling to hold above the previous highs. We're having large pullbacks still. At this point, around the phase A area, we are going to have a point where we're going to build liquidity. Now, this is what we call inducement. You see at this level, a lot of people are going to be seeing this as resistance. We've got many wiki rejections from it, many people entering sell positions with their stop loss just above. That is a whole reason we have then come higher to break through this region, creating an up thrust in the scheme of that schematic. And then straight after that, the other key point I wanted to mention was a displacement. So in the scheme of the uptrend that we see in phase A, phase B, we have high set, low set, higher high, higher low, higher high, and then we've come down and we have surpassed what should have been a protected low, given we wanted the bullishness to continue. So this to us then becomes a displacement because we have shown signs that we're ready to run the liquidity lows and start protecting the liquidity highs. Straight after that, we trade back up, mitigating positions within the up thrust, because for the up thrust to be created, for us to build and then manipulate so much liquidity like we've done here with this level of inducement, we have to have smart money or composite man presence, because we need to execute a large buy position to push price through, which therefore needs mitigating. That is the purpose of the last point of supply. Price has one major move back up, mitigating positions, and then because we've had the displacement, as I said, assuming this is being a protected high, we then start seeing it break down, running the liquidity low. So the main thing to watch out for, and this is done in an accumulation, which we'll find an example for, but watch for the inducement. This is typically going to be in phase A. Watch for an area where we're building liquidity. watch for the manipulation of that liquidity, and then straight afterwards, the displacement, because after we have cleared this liquidity, we should have injected enough momentum to then tilt the supply and demand balance in the opposite direction, allowing price to run far enough down to displace the low, early signs of the reversal. And at this point, I'd want to try and get involved pretty much anywhere after the displacement. So identifying our last buys before sells, waiting for price to trade back into it, executing a short, and then going lower. Now, looking inside of this accumulation, one thing to note is that when we build liquidity, it's not always done so through the use of a static support or resistance level. It's not always going to be that price is constantly tapping off one static line, one horizontal line within the market. It can also be done so through the use of trend lines, for example. So if we were to draw a line of best fit along this region, we would probably argue that this is what we're looking at. You can see that what's happened here is that we are having manipulations of the trend line constantly. Now, on top of that, we can argue that every single swing low holds liquidity because people on the lower time frames are using that as protected lows, protected highs. So as you see here, all of these points act as liquidity lows. Every single one. Now, when we have a spring, we're going to see it surpass all of the liquidity lows. So you'll see here we actually have two manipulations. Firstly, we're building all of this liquidity up, all of these liquidity lows. And then we see this spring push through, clearing all of this. So this, A, manipulating people out of the market, also giving us a chance to introduce enough demand. But then we've also done it again here, where we come to test the spring and also manipulating all of this liquidity out of the market. After doing so, we have then allowed ourselves to introduce enough demand to cause the movement higher. We then see this displacement of the high. After we see that displacement, we have basically confirmed to ourselves that we're no longer running liquidity lows. We're now going to start running the liquidity highs. After we see price show its want or desire to start running liquidity highs, we can assume that we've now reversed the trend, wait for price to pull back, find a region to get involved in, and then continue from there. So that is going to conclude this video, this learn to trade video. I know that there wasn't so much detail, but I just wanted to try and focus on the laws that I use, which is the law of liquidity clearance and manipulation, so inducement and momentum, and then also the law of displacement. Now, all we need to see is the creation, then manipulation of liquidity, the displacement, and then we have confirmation that price is reversing. Just remember that. Don't try and identify every single event, every single phase within the distribution or what you believe to be a distribution or accumulation. Just wait for creation of liquidity, manipulation of liquidity, and then the displacement. And to me, that is enough confirmation that we are seeing a schematic. Why do I stress this? Well, that's because every single schematic is going to be different. No two schematics will ever be exactly the same. And because of that, we can't follow a very arbitrary system in terms of identifying them, looking for certain events, certain phases, looking for it to follow one set image. Instead, we want to just look at the laws. So what really is an accumulation? What really is a distribution? We've gone through that. So now when you're identifying these or trying to confirm an entry, you should be so much more knowledgeable on what it is you're exactly looking for. Regardless, thank you guys for watching. Please leave us any feedback in the comments. Leave a like if you enjoyed, and we'll see you next time when we're on the Learn to Trade series.